Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. BlackRock releasing their 2025 Global Outlook, writing, "We stay risk on as we look for transformation beneficiaries and go further overweight US stocks as the AI theme broadens out." Wei Li of BlackRock is with us here in New York. Wei, it's good to see you, as always.
Thanks for having me.
AI beneficiaries. At the moment, it's been the big AI enabler, the likes of NVIDIA, which has been the big winner. How does that story change? What's the next phase of this trend?
We continue to like the big tech part of the AI beneficiaries. So far this year, they've been carrying the weight in terms of earnings growth. Looking at 12 months trailing, Magnificent Seven grew their earnings by 45% year-on-year basis, versus the rest of the market actually growing only 4%. So there's a significant difference, continues to be very, very concentrated. But over time, we do expect the beneficiaries to broaden out. We're looking at energy, we're looking at utility, we're looking at industrials as we build and finance the transformation, right? So certainly we have to look at the combination of public and private market as the theme plays out. We continue to think that this is an environment of transformation rather than an environment of your typical cycle. So given all these mega forces, not just AI, but also low carbon transition, geopolitical fragmentation, we're learning real time what the longer term trend is heading towards instead of the fluctuations around a typical stable longer term trend. And that has significant implications on investing over the long term. What is neutral in this environment, right?
Wait, you can't talk specifically about this deal that BlackRock announced yesterday about buying this credit fund manager, but you talked about the convergence of public and private markets. How much are you increasing your allocation to private markets as part of the sort of extra uber overweight of this broader theme?
Well, private market has been growing significantly in recent years, and looking ahead, a private market is expected to double in AUM by the end of the decade from the 2023 level. And within that, actually, infrastructure and private credit are likely going to play a big role, both as we think about building the transformation and also as we think about financing the transformation. And so far, if you look at allocation to private markets for a lot of investors, they are quite heavily in real estate, in private equities. So private credit and infrastructure are really exposures that we do think will grow both in terms of the asset base, but also in terms of their allocation in investor portfolios.
That's where I wanted to go, this question of what it means to be even more bullish on U.S. equities and the story of AI. Where are you focusing in getting more bullish? And have you ever been more bullish on some of these names?
Well, right now, as you know, we have been bullish on U.S. equities for all of this year. So we're dialing up risk-taking even more because we do believe that earnings can broaden out, right? We talked about this year being still quite concentrated in terms of big tech doing the heavy lifting. Next year, big tech, Magnificent Seven, expected to grow their earnings by 18% versus the rest of the market, high single digit. You do see the gap closing, and that broadening out is one reason that we believe there is more momentum for U.S. equities to run higher. Another reason is that people look at how expensive U.S. equities are, how concentrated U.S. equities are. Our study shows that if there are good reasons, mega forces, structural forces that could potentially change the longer-term trend, the mean revert doesn't quite apply. Mean revert to what if the destination and the makeup of the destination is changing, which is why we're not over-indexing on the current valuation level, especially as we look at investing over the tactical horizon of 2025, and the near-term tax cuts and deregulation talks can drive sentiment further, which is why we're leaning into it.
When you look at your global outlook, you talk about the focus on the United States and what you're seeing in terms of security priorities, national economic priorities at the expense of others. Who is the U.S. winning at the expense of, when you look at it, the biggest?
Well, when we look at 2025, U.S. exceptionalism is a theme that we expect to play out for the entirety of this year. Within equities, that means that we prefer U.S. equities versus the rest of the world. We use a UK equity downgrade to fund our U.S. equity upgrade. So there is a bit of a kind of leaning back into U.S. equities, but within duration, within government bonds, because U.S. exceptionalism also is associated with greater fiscal spend, we actually prefer international duration like UK gilts market over U.S. Government bond, U.S. duration, where we expect term premium to come back even more, reflecting the higher fiscal trajectory. We also continue to like quality income within a credit, even though spread is very, very tight. From a total yield perspective, it's reasonable, and the tighter spread really reflect the fact that the governments have become more indebted and private sector has been actually managing their leverage somewhat more reasonably.
Wei, it's good to see you. Thanks for joining us here in New York City. Thank you very much. Wei Li there of BlackRock. The team over at State Street writing the following: we expect the narrative of rate cuts and resilience to hold in 2025 and for our projected soft landing to materialise. This landscape extends our favourable outlook for equity markets. Heinel of State Street joins us now for more. Laurie, welcome to the programme. Do you not think that the policy changes that we could see in the next 12 months would be potent enough to disrupt the kind of resilience that you're looking for?
Well, it's too early to tell. I mean, obviously, there are a number of cross currents in what the Trump administration is proposing that could be a threat to what we've seen as a soft landing so far. But until we actually have the ink dried on some of those policies, it's hard to know how those crosswinds will actually impact the real economy.
The political changes elsewhere have been a threat to markets elsewhere, that's for sure. Check out the euro, holding on to 105 briefly, looking at 104 again this morning. Over in South Korea, we've seen the disruption there as well. Laurie, is there scope for some performance ex-US at a time when a lot of people are on this program saying, buy one thing, buy America?
Yeah, well, right now we still are on the momentum bandwagon also. I mean, what worked well in 2024 is likely to persist in 2025, and that suggests that U.S. large cap in particular has room to run here. But what we've also been talking about is a broadening out. So it's not just about the high-flying Mag 7 tech names. It's about financials. It's about, potentially energy. It's about other places like consumer discretionary that may benefit from an upgrading of the U.S. economic prospects. So it's a little bit of a nuanced story, but yes, sadly or not so sadly, we're still buy American large cap is our primary call.
I can't find one person who's not, Laurie. And this to me is really a key question. How do you hedge against the idea that at some point the momentum does run out?
Yeah. Well, I think there are a couple of things that we're doing. I mean, first and foremost is we are trying to avoid those higher, high-flying names and looking at quality or companies that can be a bit more durable through this kind of cycle. The other thing is broadening out a little bit, looking at small cap U.S., for example, which might have a little bit less vulnerability to some of these global crosswinds. And to look for diversifiers. So we have had a position in gold in our portfolio because, as you've seen over the last couple of years, stocks and bonds are often moving in lockstep. So getting some diversification into the portfolio so that you have something that's going to zig when the rest of the world zags is very important for us as well.
This is important. Are you basically saying that 60-40 and the concept behind it has been upended? That essentially we are looking at bonds that no longer are the diversifier. You're looking at moving out into other types of companies and gold. You didn't mention bonds once within that. So at a certain point, does this have to fundamentally upend the way people construct their portfolios?
Well, not necessarily. And in fact, I think in some ways we're in a better position than we were a few years ago when interest rates were zero. So at that point in time, we were very much in the camp that bonds just weren't providing the kinds of benefits that investors typically needed to enjoy from them. But we do now have some income in bonds. So despite the fact that equities have powered forward, S&P up 25% or so on a year-to-date basis, with fixed income kind of earning a coupon, it's still earning a coupon. So it's really more about a nuanced positioning. So definitely still retain that allocation of bonds. We think that they're going to return at least coupon, perhaps plus, but looking for other things, especially if we have some, drawdown risk in the equity markets.
Well, when you look at potential drawdown risks in the equity market next year, is it policy coming from Washington? I know you're bullish in the fact that potentially we're going to have these tax cuts, looking at your research, but how do you look at tax cuts potentially next to the walls going up and higher higher tariffs?
Yeah. I mean, this is the thing. There are crosswinds even within the stated policy objectives, right? So if you think about immigration, potentially it takes labor away from sectors that are already a little bit vulnerable. Think housing. If you look at tariffs, obviously that creates vulnerability around the inflation front. We do think that the Fed is going to cut here in December, but we think that next year's cuts are a bit in jeopardy as we wait for this agenda to kind of play through. So that's what's really tricky for investors right now, is it's hard to know precisely where the dust settles.
If investors wanted a base case for next year and how potential Trump policies might impact the Fed, would you say there's this idea of pauses for 2025 or even potentially a hike?
Yeah, so we had originally penciled in 4 rate cuts in 2025, and we're now really lowering that, looking at maybe 2, probably a pause around the beginning of the year, in part to see how these policies do shape up. And by the way, the Fed, if they do cut this month, and especially if they cut for 25 basis points, they'll have cut 100 basis points. So while we think that there's more to be done and we'd like to see them do more, we think that it's likely that a pause in early 2025 is warranted.
Laurie, all the Fed speak over the last few days just giving us the impression that they believe, these Fed officials believe, there's a long way to neutral. I was going through some of what Fed Mary Daly had to say, what the Chicago Fed President Goolsbee had to say, Governor Waller more recently as well. Where are you on that? Just how far away are we from what they consider neutral to be?
Oh, we agree there is a long way to go for neutral, but the problem is that we could have some inflationary pressures budding in the early part of 2025. And so one of the things that they also have to be very mindful of is that they don't cut so aggressively that they're in a position of having to hike more rapidly than they would have liked. So we've always said that this inflation trajectory was not going to be a sort of smooth, one-way direction. There was likely to be a little bit of bumps along the way. So it's more a question of timing. But we do think that neutral is quite a bit lower from here.
Chairman Powell speaking at 1:40 later on this afternoon. Laurie, appreciate your time. Enjoyed the outlook. Thank you. Laurie Heinel there of State Street. BMO's Ian Lyngen with this to say. The incoming Fed rhetoric has been consistent in the messaging that while rate cut decisions are being made on a meeting-by-meeting basis, there is appetite among committee members for another move this month. Ian joins us now for more. Ian, good morning. Good to see you.
Good morning. Thanks.
You've identified this, and I want to go straight to it. Let's not bury the lead. Why is the 2-year at 4.20? Fed's coming out and saying we're all confident we're above neutral. We've got a long way to go. They want to reduce interest rates. Yet we've got this 2-year yield that is just stubbornly above 4%, just sort of stuck there at 4.20. What's that about?
I think that the market at the moment is still trading the results of the election. They're more worried about inflation or a surge of reflation. They're more worried about what happens when there's a renewed trade war. They're not listening to the Fed. They're not worried about the Fed cutting in December, then going again in Q1 and Q2. In a typical environment, one would expect effective Fed funds, which on December 18th will be 4.33, to function as a ceiling for nominal rates when the Fed is cutting. Right now, we could very easily find that uninverted sooner rather than later, which I think would create an interesting dynamic for the market for sure.
So who's right? Is the Fed right or is the market right?
At this moment, I think that the Fed is correct in continuing to normalize rates because they're normalizing rates not because the economy is slowing, not because the jobs market has turned over, but because they believe they have won the war on inflation. And I think that's a nuance that we as a market often overlook. Normalization is not easing. It's just cutting back to neutral.
At the same time, and this really does go to the point that I think the sort of battle of the Ians, I'm going to call that all morning, really goes to, where you can take a look at something like the JOLTS report and say it's either really solid and shows ongoing strength, or you could say that the overall trend is downward. What's the right signal at a time when you hear companies that are talking about reinvesting in their businesses, hiring, after the election uncertainty has been resolved, really leaning into the whole idea of American exceptionalism?
Well, I'm very sympathetic to Ian's argument that we are overdue for a spike in the unemployment rate. The trend has been lower, but the reality is the data continues to show a resilient labor market as a theme. We have an unemployment rate at 4.1%. That's very low by historic standards. The concern, and I think this is shared among a lot of the Ians that I know, is that there's going to be an eventual spike in the unemployment rate that then gets the consumer on the wrong foot.
When it comes to the jobs report on Friday, what number would give the Fed a reason to say we're going to stay on pause?
We need to see a very significant headline print or a 3 handle on the unemployment rate. You give me a 350 headline payrolls and a drop in the unemployment rate, then the question becomes, and it's a legitimate question, is neutral in fact higher? Have we not been as restrictive as 550 might have been in prior cycles? I really think it ultimately comes down to whether or not we see a unexpectedly higher CPI number, not payrolls. Because, again, to the point, they're cutting because they believe they've won the war on inflation, not because they're worried about jobs.
Right. So when you look at 2025, and you alluded to this idea that the market is taking the cues from the political economy, the policies that might come out of Washington, what does that mean for the Fed come January?
Well, there are only so many things that Trump can do when he immediately takes office without Congress. So I think that the Fed pauses in January to see what those things are. So they take that median off, they reassess the situation, they see the trajectory of growth, they see if the type of tariffs that are announced are the type that they would characterize as a tax on the consumer or would really trigger reflation. I suspect it will be more of a tax on the consumer, a one-off increase in CPI, and then we just move forward.
And do you think that people are underestimating the chance of a slowdown, a material slowdown in the U.S. economy, as everyone talks about incredible profitability and this incredible boom in the stock market and beyond?
I would say that at this moment, people are underestimating the chance that we have a slowdown. What I'm the most concerned about is historically, the Fed has been very successful at taking the edges off of the cycle on the upside and the cycle on the downside. This is what central banks are designed to do. And that has resulted in all of the major corrections occurring as in the form of a crisis. So where are the imbalances? Record high stock prices speaks to this idea that there's a lot of optimism out there and a lot of optimism that's overlooking the potential downside. So a little bit nervous in terms of valuations in the equity space as well as generally in risk assets.
Try and set policy for that, the two-way risk into 2025, both to the upside and to the downside.
Yeah, well, I have to say I'm not a little happy that I don't have to do it. So good luck to all of the people on the committee.
Good luck to Chairman Powell,
exactly,
who speaks later on this afternoon. Ian, thank you. It's good to see you. Thank you, sir. Ian Lyngen there of BMO. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.